If you had invested $1,000 in the beginning of 2013 in the S&P 500, by the end of 2022, 10 years later, you would have had more than $3,200. That translates to a 12.4% annual return. If you had invested in T-bills, you would have had only $1,080. And if you had invested in gold, you would have had about $1,100. So clearly, stocks offer much higher returns. In fact, stocks look even more attractive if you look at longer term. Taking it to the extreme, if you had invested $1,000 in the beginning of 1928, by the end of 2022, you would have had more than $6 million. The S&P 500 consists of 11 sectors such as technology, healthcare, energy, financials, and a few others. When you invest in an S&P 500 fund, you are investing in all of these sectors at the same time. However, some of these sectors tend to outperform the overall stock market, such as technology, healthcare, and consumer discretionary, while others tend to underperform, such as utilities. Even within a given sector, some industries tend to outperform others. A savvy investor tries to identify those sectors and industries that outperform the overall stock market and focuses on investing in those. You can easily do so by purchasing the right ETFs. In this video, we'll introduce a few ETFs that have outperformed the S&P 500 over extended periods of time and are likely to continue doing so in the future. These ETFs meet a few requirements such as being non-leveraged, having a low expense ratio, reasonably high trading volume and assets under management, and most importantly, having a long track record of beating the S&P 500. I personally regularly invest in all of these ETFs, but of course, you should definitely do your own due diligence before investing your money. So let's dive right into it. First, let's introduce my number one favorite ETF, which is SOXX. Out of the 11 sectors in the S&P 500, the technology sector has had the highest returns, and within the technology sector, the semiconductor industry tends to outperform other industries. The semiconductor industry continues to enjoy astronomical growth thanks to increasing demand for consumer electronics, artificial intelligence, cloud computing, and other emerging technologies. SOXX provides exposure to the 30 largest US-listed semiconductor companies. Its top holdings are NVIDIA, Broadcom, AMD, Intel, and Texas Instruments. Over the past 10 years, its annual return has been 25%, which is more than double the S&P 500 return. This means that your investments would have grown 8-fold in 10 years. The Vanguard Information Technology ETF, with ticker symbol VGT, is another amazing ETF which provides exposure to the outperforming technology sector, specifically US-based companies in the information technology industry. Its top holdings are Apple, Microsoft, NVIDIA, Broadcom, and Adobe. Over the past 10 years, its annual return has been around 20.6%, which is way better than the S&P 500. The next ETF on our list is the popular QQQ. This ETF provides exposure to the top 100 largest non-financial companies listed on the NASDAQ. This ETF is heavily weighted toward tech stocks, and therefore it's a great option for those who want exposure to this high-growth tech sector. Its top holdings are Apple, Microsoft, Amazon, NVIDIA, and Meta. Over the past 10 years, its annual return has been around 18.7%, which is again way better than the S&P 500. Our next ETF is the iShares Russell Top 200 Growth ETF with ticker symbol IWY. As the name implies, this ETF provides exposure to growth stocks chosen from the 200 largest US companies. This ETF has a lot of overlap with QQQ, so feel free to choose only one of the two options. Its top holdings are Apple, Microsoft, Amazon, Nvidia, and Google. Over the past 10 years, its annual return has been around 16.5%, which is again way better than the S&P 500. Our next ETF is a healthcare sector ETF with ticker symbol XLV. The healthcare sector is another sector that has outperformed the S&P 500 in the long run. With XLV, you get exposure to only the healthcare stocks within the S&P 500. Its top holdings are United Health, Johnson & Johnson, Eli Lilly, Merck, and AbbVie. Over the past 10 years, its annual return has been around 12%, which is slightly lower than the S&P 500 return. However, over a longer time horizon, XLV has outperformed the S&P 500. Another benefit of XLV and the healthcare sector in general is that in market downturns, they tend to hold value much better than tech stocks. So investing in the healthcare sector is a great way to hedge a tech-heavy portfolio. Our next ETF is the iShares US Medical Devices ETF with ticker symbol IHI. This is a niche ETF within the healthcare sector that focuses on only the medical devices industry. The XLV ETF invests in the entire healthcare sector, including pharmaceuticals, healthcare providers, medical devices, and others, whereas IHI focuses on only the medical devices industry, which has been the best performing industry within the healthcare sector. Its top holdings are Thermo Fisher, Abbott, Medtronic, and Intuitive Surgical. Over the past 10 years, its annual return has been around 15.8%, which is way better than the S&P 500. Our next ETF is a consumer discretionary sector ETF with ticker symbol XLY. The consumer discretionary sector, which includes industries such as entertainment, restaurants, and hotels, is another sector that has historically outperformed the S&P 500 in the long run. With XLY, you gain exposure to only the consumer discretionary stocks within the S&P 500. Alternatively, if you want exposure to a broader range of consumer discretionary stocks that are outside the S&P 500, then you can invest in another ETF with ticker symbol VCR. Its top holdings are Amazon, Tesla, Home Depot, McDonald's, and Nike. Over the past 10 years, its annual return has been 12.6%, which is similar to the S&P 500. However, over a longer time horizon, XLY has outperformed the S&P 500. There you have it. Now you know a few ETFs with amazing returns that tend to outperform the S&P 500. Which one is your favorite? I hope you found this video helpful. If you got any value from this video, don't forget to give it a thumbs up, subscribe to the channel if you haven't already, and leave a comment or question below. Thanks for watching, and see you next time.